The next piece of the radical investment approach is liquidity risk. Now, this risk is something that's often not mentioned. But what is liquidity? Well, liquidity is how quickly you can get access to your money. If you can't get access to your money quickly, then you have liquidity risk. So, for example, if you buy a property and you want to sell that property quickly, if you need access to that money in the next month, how easy is it to sell a property in a month? And if you've ever done it, you know it's really, really difficult. In fact, it's probably nearly impossible. And if you were to do it, you'd have to accept such a ridiculously low price for it to be feasible. So liquidity risk applies to many types of investments. Quite often you'll see guaranteed and structured products that are mentioned, they'll say, well, we're going to give you 7% a year growth as long as the FTSE doesn't fall by more than 50%. In fact, there was one just recently in the news in the last week where all of the investors are going to lose 100% of their money because they've got these guaranteed types of bond investments and the underlying provider of them has gone bust. Liquidity risk is a real problem. If you can't get access to your money when it's falling, then you can sit there and watch it go to zero. So we encourage clients to not go into anything that has liquidity risk. Property obviously has its place in a portfolio, but you certainly wouldn't want all of your money in a property portfolio because of you wouldn't have the asset allocation, the split of the investment, but B, you'd have massive amounts of liquidity risk. So be warned, be careful where products are promising you returns that seem to be too good to be true, because one of the exchanges that you'll make for that is giving up the access to your money, and that could cost you the whole lot. Now that we've touched on property, it's worth talking about the changes that happen to the buy-to-let market, because buy-to-let investing has been phenomenally popular in the UK. We all know that the UK investor loves property. It's all over every newspaper and it's talked about an awful lot. The problem is the government doesn't, and as a result, they're making some significant tax changes to make it really unattractive to be a buy-to-let investor, particularly if you borrow money. What they're doing is they're phasing out the opportunity to offset your mortgage interest against the rent. So in other words, if you're getting £1,000 a month rent, but paying an £800 a month mortgage, until recently that meant you'd got a £200 a month profit and you only paid tax on the £200. By 2021, you'll be paying tax on the full £1,000. So as a higher rate taxpayer, that would be £400 a month in tax, meaning that you've now gone from a £200 a month profit to a £200 a month loss. That's going to be extremely painful, and we're already seeing quite a few buy-to-let investors wanting to exit that market. Compound that with a 3% additional stamp duty plus rising interest rates, which are likely to happen in the coming years, and you've got a ticking time bomb with regards to the buy-to-let market. So be careful of that area in particular, not just for liquidity risk. I'm not saying sell everything in the buy-to-let market, but you certainly wouldn't want to have all your eggs in that basket for sure. The final piece of the radical investment approach is the trick to stop your investments getting riskier and riskier. Because naturally, over time, that's what happens. Your investments gradually get riskier and riskier, and that means that when there is a market crash or disaster of some description, you get affected far more painfully. So what can we do to avoid that, or what's called rebalancing? So let's have a look at why rebalancing is important. So if I took a typical portfolio for somebody, let's say we put 50% in low risk investments, 30% in medium risk investments, 20% in high risk investments. It's pretty well spread out in terms of the risk. So what would you expect? Well, you might expect from 1 to 5% growth on the lower risk investments per annum. You might expect as much as 27% growth from a medium risk investment in any 1 year, but equally it might fall as much as 23% in any 1 year. And then for a high risk investment, you may see growth of 135% in any 1 year, but equally you could see the whole thing wipe out. We avoid things that, for our clients, that the whole thing is likely to wipe out, but in theory it's a high risk investment, so that could happen. So let's look at an example. So £100,000 invested over 10 years. So if we put £100,000 into this portfolio, we're going to have £20,000 in the high risk bit, because we said we wanted 20% in high risk. And let's assume we get 15% growth on that money each year. We've then got £30,000 in the medium risk, and that, let's just say that delivers us 10% a year growth on average. And then finally, we've got £50,000 on low risk, and let's assume that delivers us 5% growth per annum over the 10 years. So what happens, we started off with a lovely triangle of risk with 50% in low risk and only 20% in high risk. But what happens over time is that we end up with a nice portfolio of growing from £100,000 to £240,000 over the 10 years. But our nice triangle has turned into a rectangle. What it means is we've now got as much in high risk investments as we have in low risk investments. So this is a much riskier portfolio than we actually wanted at the start. So gradually over time, our triangle has turned into a rectangle, and the portfolio's got riskier and riskier. And not only do we not want the portfolio to get riskier and riskier, potentially we may want it to actually become less and less risky, because generally the older you get, the less risk you want to take. So actually this has worked against us twice, really. So what's the trick to this? The trick is rebalancing. So it's basically banking the returns from the higher risk areas and locking them into the lower risk areas, saving them, protecting them, so that when the higher risk areas do have their bad times, you've locked down some of the gains you've had from them. And rebalancing is shown to add an extra amount of growth each year. And in fact, if you do it really well and you do it at specific triggers when the market moves in certain ways, at the optimum times, you can add somewhere around up to 0.5% per annum extra growth to your portfolio. So again, that's another simple way of just getting a bit more compound growth in your portfolio. So what is the right investment strategy? Well, the right investment strategy is having a properly diversified portfolio spread across the different asset classes, but in proportions that are right for your level of risk. And ultimately, if you do that bit right, that will drive 80 to 90% of the returns that you get. And it's worth just looking at what that's looked like historically. So this chart briefly looks at, what it looks at is that over the last 3 years, what did you get in cash, which is the bottom green line? What was inflation? So that's the next flat orange line up. Then if you took the average of all the diversified funds, so the ones that are split across multiple different asset classes, then that is the turquoise line. So the average of all the funds, all the rubbish ones and the good ones, all collected together, is the turquoise line. As you can see, it was significantly better than inflation or cash. And then the red line was the discretionary manager we were using for our clients. Now, of course, past performance is no guide to the future, but ultimately, this is showing you what the portfolio can do. So if you get the right investment approach, you can get your money working as hard for you as possible and getting you the best returns possible for a level of risk that you're comfortable with.